What's shaking, crypto crew? Get ready, because the news cycle is absolutely on fire, and you're locked into Bitcoin Bulletin for the absolute latest, the most impactful, the stories you need to know. We're diving headfirst into a market that's moving faster than a lightning bolt, with game-changing developments hitting us from every angle. From the political arena to the digital frontier, the landscape is shifting, and staying informed is your superpower. Are you ready to unpack it all? We've got a packed show today, so buckle up as we break down the seismic shifts happening right now in the world of digital assets. You won't want to miss a second of this. Let's get into it. First up, we're seeing a fascinating convergence as political powerhouses step into the crypto arena. Get ready to hear about how a prominent political family's foray into digital assets is sending shockwaves through the market, sparking intense debate about influence, regulation, and the future of decentralized finance. This is more than just a story about tokens. It's about the evolving relationship between power, politics, and the digital economy. Then, we're shifting gears to the macroeconomic forces that are shaping our portfolios. With crucial U.S. labor data on the horizon, markets are bracing for potential volatility across all asset classes. We'll break down exactly what these numbers mean for inflation, interest rates, and critically, for your crypto investments. Will the Fed pivot, or will they hold firm? The answer could be in this week's employment figures. And finally, we're diving deep into the technicals and on-chain data that could be signaling the next big move for Bitcoin. Despite current price action, massive accumulation might be happening beneath the surface, with key metrics pointing towards a significant bull case building. Is the market consolidating for a monster breakout? We've got the analysis that could set you up for what's next. Stick around, smash that like button, subscribe, and hit the notification bell so you never miss an update. Political power plays Ignite Crypto Market, sir. Get ready for a story that's blending political dynasties with digital currency innovation, creating a ripple effect across the entire crypto landscape. In a move that's capturing headlines and sparking fervent discussion, the cryptocurrency market is witnessing a remarkable surge, particularly among altcoins, even as Bitcoin maintains a steady, stable presence. This resilience from the leading cryptocurrency comes despite a significant $300 million inflow into Bitcoin exchange-traded funds, a clear indicator of sustained institutional confidence. However, the real buzz is around the unexpected players entering the digital asset space, most notably the Trump family. The Nasdaq listing of American Bitcoin, a company co-founded by Eric Trump and Donald Trump Jr., has seen its stock price initially soar by over 90%, demonstrating a potent mix of political brand recognition and crypto asset interest. This event not only highlights the increasing intersection of traditional finance and the burgeoning crypto industry, but also raises critical questions about regulatory oversight and potential conflicts of interest. Adding to this narrative is the dramatic spike in the value of a token issued by World Liberty Financial, a decentralized finance platform with ties to the Trump family. Following its public debut, the WLFI token rapidly climbed the ranks, becoming the 27th largest cryptocurrency by market capitalization. This dual development positions the Trump family at a unique nexus of political influence and cryptocurrency investment, leveraging their public profile to potentially shape market dynamics and attract considerable attention. It's a potent combination that underscores the evolving nature of wealth creation and influence in the digital age. The broader economic climate is also providing a fertile ground for this growth. Bitcoin's recent rally, occurring in tandem with gold reaching all-time highs, reinforces its established role as a hedge against macroeconomic uncertainty. Analysts are pointing to the strong probability of a Federal Reserve interest rate cut, with market indicators showing over a 95% chance of a reduction in September. Such a move, typically accompanied by a weakening U.S. dollar, often benefits assets like Bitcoin and gold, which are seen as alternatives to traditional fiat currencies. This macroeconomic backdrop provides a tailwind for digital assets, encouraging investment and bolstering their appeal as inflation hedges. However, the landscape is not without its challenges. The altcoin market, while showing impressive momentum, remains inherently volatile. Many of these alternative tokens face skepticism from traditional investors who question their long-term viability and intrinsic value, often attributing their rapid growth to speculation and hype. Furthermore, the regulatory environment remains a significant concern, with various governing bodies worldwide closely monitoring and scrutinizing the expanding influence of cryptocurrencies in global financial systems. The potential for stricter regulations could introduce new uncertainties. Despite these headwinds, the current market trends suggest a maturing and diversifying crypto ecosystem. The interplay between increasing institutional adoption, relentless innovation in decentralized finance, and influential macroeconomic factors is creating a more complex and dynamic market. The continued growth of altcoins, alongside Bitcoin's foundational stability, points towards a future where digital assets offer a broader spectrum of opportunities and risks, fundamentally reshaping the investment landscape. But what happens when political strategies and crypto investments collide? We'll explore the wider implications next. Then, brace yourself as we unpack the economic data that could send shockwaves through the markets. Economic signals point to market volatility as U.S. labor data looms. Markets are on edge, awaiting crucial U.S. labor data that could dramatically influence monetary policy and trigger cross-asset volatility. As the global financial stage prepares for the release of pivotal U.S. labor market statistics, including jobless claims and the highly anticipated non-farm payrolls report, a palpable sense of anticipation and caution has settled over investors. These figures are not merely economic indicators. They are critical inputs for the Federal Reserve as it navigates the delicate balance between curbing persistent inflation and acknowledging signs of a cooling employment landscape. Federal Reserve Chair Jerome Powell himself has acknowledged this growing tension, noting at the Jackson Hole Symposium that the risks to the employment side of the Fed's mandate have significantly increased. Throughout the year, labor market data has consistently played a decisive role in shaping market expectations regarding monetary policy. Earlier in the summer, a slight uptick in unemployment to 4.1% led to a rally in risk assets and a fall in Treasury yields, as speculation mounted that the Fed might adopt a more dovish stance. Conversely, stronger-than-expected reports have previously reignited fears of tighter monetary policy, pushing yields higher and applying downward pressure on both equities and digital assets like Bitcoin and Ethereum. Experts are emphasizing the far-reaching impact of this week's data. Canny Lee, CEO of SecondSwap, highlighted the global repercussions, stating, "This week's jobs report may be domestic, but it shapes expectations for liquidity globally, and crypto markets often react more sharply to those shifts than other assets." This sentiment is echoed by John Murillo, Chief Business Officer at BetaBroker, who described the labor market as being in a curious balance, characterized by steady unemployment but a slowdown in job creation. Murillo explained, "A disappointing jobs report could reinforce the Fed's more cautious stance, driving yields down and giving a boost to riskier assets." He further elaborated, "On the flip side, if job growth surprises on the upside, it could complicate the Fed's decision-making and reignite hawkish sentiments." Alexis Surkia, captain of Yellow Network, pointed out that the market's extreme sensitivity to this single report underscores deeper structural issues within the financial system. This week's job numbers might be a big deal for markets. If the report is strong, it could mean the Fed keeps interest rates high, which might be bad for stocks crypto. If it's weak, people might hope the Fed will cut rates, which could make stocks crypto go up, he stated. Surkia also argued that this volatility highlights the pressing need for a financial system that is more trustable and doesn't rely on single centralized entities emitting politicized opinions. As global investors digest this crucial U.S. economic intelligence, they are also simultaneously parsing purchasing managers' indexes, PMIs, and other leading indicators. This confluence of data points is setting the stage for a week marked by significant cross-asset movements, all closely tethered to the resilience and trajectory of the U.S. economy. The outcome of these labor reports will undoubtedly be a primary driver of market sentiment and a key determinant of asset performance in the immediate future. Will regulatory bodies step in to clarify the crypto landscape? We'll delve into the latest moves from the SEC and CFTC next. Regulatory crossroads. SEC and CFTC signal shift in crypto oversight. Key U.S. financial regulators are indicating a potential recalibration of their approach to digital assets, with significant implications for Bitcoin spot trading. The Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, are reportedly signaling a notable shift in their regulatory strategies concerning digital assets. This evolving stance, particularly in relation to Bitcoin spot trading in the United States, could represent a pivotal moment for the cryptocurrency market. While specific details remain under wraps, the mere indication of a coordinated or adjusted approach from these powerful agencies has sent ripples through the industry, prompting analysts and market participants to speculate on the potential impacts. Historically, the regulatory landscape for cryptocurrencies in the U.S. has been complex and often fragmented, with the SEC and CFTC asserting jurisdiction over different aspects of the market. The SEC has primarily focused on classifying digital assets as securities, leading to stricter oversight and enforcement actions against projects deemed to be offering unregistered securities. The CFTC, on the other hand, has generally viewed many cryptocurrencies, including Bitcoin, as commodities, regulating them through derivatives markets like futures contracts. This divergence in approach has created a degree of uncertainty for businesses operating in the crypto space and for investors seeking clarity on market rules. A unified or more clearly defined regulatory framework could streamline operations, foster greater institutional adoption, and enhance investor protection. For instance, the approval of a spot Bitcoin ETF, a long-awaited development, hinges significantly on regulatory clarity and the perceived risks associated with the underlying asset and its trading markets. The implications of a regulatory shift could be far-reaching. If regulators adopt a more accommodating stance towards spot Bitcoin trading, it could unlock significant capital inflows from both retail and institutional investors who have been waiting for a clearer path to market access. This could lead to increased liquidity, price discovery, and overall market stability. Conversely, any new regulations, even if intended to provide clarity, could also introduce new compliance burdens or restrictions that might temper market enthusiasm or favor certain business models over others. Industry stakeholders are closely watching for any concrete policy changes or pronouncements from these agencies. Many anticipate that the ongoing dialogue between regulators and the industry will continue to shape the future of digital asset regulation. The goal for many is to strike a balance between fostering innovation and mitigating risks associated with market manipulation, fraud, and investor protection. The actions of the SEC and CFTC in the coming months will be critical in determining the trajectory of Bitcoin spot trading and the broader digital asset ecosystem in the U.S. Will Bitcoin's quiet trading hide a storm of opportunity? We'll break down the on-chain data that suggests a major bull case is brewing. Bitcoin's price plateau hides a powerful bullish undercurrent. Despite a period of stagnant price action, on-chain data and market indicators reveal a robust foundation for Bitcoin's next significant upward move. Bitcoin has recently been navigating a period of consolidation, trading within a relatively narrow price range between approximately $107,557 and $111,961. This sideways movement might appear uninspiring to some, but beneath the surface, several key metrics suggest that a powerful bull case is steadily building. Notably, despite the flat price action, the leverage in the derivatives market has continued to climb, as indicated by the Bitcoin Estimated Leverage Ratio, ELR, increasing since early August. This trend suggests that traders are not exiting the market, but rather increasing their exposure, signaling a growing confidence in the short-term outlook and a potential precursor to a breakout. Further bolstering this optimistic view is the net unrealized profit loss, NUPL ratio, which currently stands at 0.52. Historical analysis of this metric shows that previous bull market peaks in 2013, 2017, and 2021 saw NUPL ratios soar to the range. The current reading places Bitcoin firmly in the middle phase of a bull cycle, with historical patterns suggesting a strong potential to reach targets between $120,000 and $150,000 in the medium to long term. Supporting this projection, on-chain data reveals that only a small fraction, 13.71%, of the total Bitcoin supply is currently held at a loss. This is a significant departure from bear market capitulation levels, indicating that a vast majority of holders are in profit, which typically supports sustained upward price movement. In the immediate term, Bitcoin has demonstrated resilience, recovering from brief dips below the $110,000 mark to hover around $111,600, with $112,500 identified as a critical resistance level. A decisive breach above this threshold could ignite a renewed recovery phase. However, a failure to maintain upward momentum could see the price remain range-bound or potentially retest the support level at $107,557. On-chain analysis also indicates a decrease in whale activity, a factor that could alleviate selling pressure and create more room for accumulation by both institutional and retail investors. The broader macroeconomic environment further strengthens Bitcoin's bullish narrative. In a notable divergence, Bitcoin has recently shown signs of decoupling from the performance of the U.S. stock market. For example, on September 2, while the S&P 500 registered a decline of 1.48%, Bitcoin saw a gain of 1.58%. This decoupling underscores Bitcoin's increasing appeal as a macroeconomic hedge, particularly in anticipation of potential U.S. Federal Reserve rate cuts. With the CME FedWatch tool indicating a 95% probability of a rate cut in September, a weakening U.S. dollar could significantly enhance Bitcoin's attractiveness as a high-beta asset. In essence, while Bitcoin may be experiencing near-term price resistance and the possibility of profit-taking corrections, the underlying data paints a cautiously optimistic long-term picture. The combination of on-chain metrics, historical cycle analysis, and supportive macroeconomic trends, including sustained institutional inflows and ETF demand, suggests that the current consolidation phase could be a precursor to substantial growth. The key for investors will be to monitor the price action around critical resistance levels, as a successful breakout could accelerate Bitcoin's trajectory toward its higher price targets. We've covered the political plays, the economic indicators, and the technicals. Now, let's wrap it all up. And that's a wrap on today's crucial updates. We saw political players make major moves in crypto, economic data poised to shake up the markets, and Bitcoin showing signs of a massive buildup beneath the surface. Don't miss out on any of these critical developments. Make sure you're subscribed, hit that notification bell, like this video, and follow us on all social platforms for real-time insights. We'll see you next time on Bitcoin Bulletin.